The million-dollar portfolio exists. The path to it is documented, replicable, and has been followed successfully by ordinary people with ordinary incomes for decades. Most of them never talked about it publicly. Here is what is interesting about that silence. It is not modesty. It is that the strategy is so structurally simple that saying it out loud sounds like you are withholding something. Like the real answer must be somewhere behind the answer you just gave. It is not. The market does not reward the smartest person in the room. It rewards the most consistent one. That single sentence has more practical value than anything a commission-based financial advisor will tell you in a 2-hour consultation. And understanding why it is true is the entire difference between a portfolio that reaches 7 figures and one that plateaus at $400,000 and stays there. So here is the exact framework, the sequence, the allocation logic, the behavioral architecture, and the one decision most people get wrong before they ever place a first trade. But before the framework, the reason most people who already know this framework still fail to execute it. The financial services industry does not profit from your consistency. That is not a conspiracy. It is a business model. Every time a retail investor repositions, moves from one fund to another, exits during a correction, rotates into whatever sector is currently on television, a transaction occurs, a fee is charged, a spread is captured, an advisor justifies their retainer. The industry's revenue is generated by activity. Your wealth is generated by inactivity. Those two things are in direct structural conflict. And the entire media ecosystem built around personal finance, the daily market commentary, the quarterly rebalancing recommendations, the breathless coverage of Federal Reserve language, exists to keep you moving when the correct behavior is to be completely still. This is the villain in every retail investor's story. Not bad luck, not bad timing, the manufactured urgency that makes patience feel like negligence. If you have ever felt that staying in index funds through a correction was somehow naive, that surely the sophisticated move was to do something, you have felt this machine working on you. It works on almost everyone. If this is landing the way it should, hold that, because the framework only makes sense once you understand what you are building it against. The sequence problem. Before the allocations, the order. Most people who learn about portfolio construction learn the components without learning the sequence in which those components should be assembled. They hear, max your 401k, invest in index funds, diversify, and they treat those as a simultaneous checklist rather than a specific order of operations. The sequence is not optional. Getting it wrong does not just slow the compounding, it actively destroys it. Here is the correct sequence. Step 1. Emergency fund first, always. Not because it earns anything. It earns almost nothing. The emergency fund's function is not to grow. It is to prevent the portfolio from being liquidated during a crisis. The number one reason high-potential portfolios are destroyed in their early years is not bad stock picks. It is a car repair, a medical bill, a job loss, some predictable category of life disruption that forces a sale at exactly the wrong moment. Every dollar pulled from a portfolio during a down market to cover an emergency is not just the dollar lost. It is every dollar that dollar would have compounded into over the next 20 years. 3 to 6 months of expenses, liquid, boring, non-negotiable, before the first investment dollar goes anywhere else. Step 2. Employer match, captured in full. If an employer matches 401k contributions up to a percentage of salary, that match is an immediate 100% return on capital before any market performance is considered. There is no asset class, no strategy, no alternative investment that produces a guaranteed 100% return. The employer match does. Failing to capture it in full is the single most expensive mistake in personal finance, not because the amounts seem large in year one, but because of what those matched dollars compound into over a 30-year horizon. A 25-year-old who captures a 3% employer match consistently and invests it in a broad index fund will, in many scenarios, see that match alone account for over $200,000 of their final portfolio. Not the contributions, the match. Capture every dollar of it before moving to the next step. Step 3. High interest debt, eliminated. Any debt carrying an interest rate above 7% is a guaranteed negative return on capital. Carrying 8, 12, or 22% interest rate debt while simultaneously investing in an asset expected to return 7 to 10% annually is a mathematical loss dressed as a savings habit. Pay it off, then invest. This is the step most financial content skips or softens because it is not interesting and it does not involve products to sell. It is also the step that, if skipped, quietly destroys the compounding math on everything that follows. Step 4. Tax-advantaged accounts. Maximized. Roth IRA. Traditional IRA. HSA if eligible. Back to the 401k. Up to the annual contribution limit. The tax treatment of these accounts is the second greatest structural advantage available to a retail investor after the employer match. A dollar that compounds tax-free for 30 years produces a materially different outcome than a dollar compounding in a taxable account, and most people dramatically underestimate the gap. Before a single dollar goes into a taxable brokerage account, tax advantage space filled. Step 5. Taxable brokerage for everything beyond. Only here, only after everything above is handled. This is where the portfolio scales beyond the contribution limits of tax-advantaged accounts, where additional index fund positions are built, and where the portfolio eventually reaches the size at which the numbers become genuinely life-altering. Before the allocation, let's pause on something. Before going further, one concept that shapes everything downstream: survivorship bias, the distortion that occurs when a sample only includes entities that passed a selection filter, making it appear that the strategy or trait that defines the surviving group is responsible for the outcome. In investing, survivorship bias runs everywhere. The mutual funds that outperformed the market over a decade are the ones that still exist. The ones that underperformed were quietly closed and absorbed. The investors who made fortunes picking individual stocks write books. The investors who lost fortunes doing the same thing do not. The practical implication: any evidence that active management or stock picking produces superior returns over long time horizons is contaminated by survivorship bias before it reaches you. The studies that control for it, that include the closed funds, the failed strategies, the investors who do not write books, consistently show the same result. Most active managers underperform a simple index fund over a 15-year period, net of fees, not because they are unintelligent, because the market is a system in which their intelligence is competing against everyone else's simultaneously, and the fee drag compounds in the wrong direction every single year. The reason this matters here is that the allocation the framework recommends is not sophisticated. That is intentional. Sophistication in portfolio construction is largely a product that is sold, not a feature that improves outcomes. Here is the core allocation framework for a long horizon portfolio being built from scratch. Broad U.S. Market Index Fund, 60%. This is the engine. A total market or S&P 500 index fund with an expense ratio below 0.1%. Not the fund that performed best last year. Not the sector ETF, currently receiving media attention. The broad market, held through everything, at the lowest possible cost. John Bogle founded Vanguard and spent his career making this argument. Warren Buffett has publicly recommended exactly this strategy for the majority of retail investors. Neither of them profits from retail investors following this advice. That is worth noting. International Developed Market Index Fund, 20%. Diversification across economies is not just risk management, it is return insurance. The U.S. market has dominated global returns for a long stretch. It will not do so in perpetuity. International exposure costs almost nothing to maintain in index form and ensures the portfolio participates in growth that occurs outside domestic markets. Bonds or bond fund, 10%. The function of bonds in a long horizon portfolio is not return. It is behavioral. When equity markets drop 30%, and they will, periodically, for reasons that will seem unprecedented and catastrophic at the time, a portfolio with a bond allocation drops less. A portfolio that drops less is a portfolio the investor is psychologically capable of holding through the bottom. The investor who holds through the bottom participates in the recovery. The investor who exits at the bottom locks in the loss permanently. Bonds are not a conservative choice. They are a behavioral architecture decision. Real assets, 10%. A right index fund, a commodities position, some form of real asset exposure that behaves differently from equities during inflationary periods. The specific instrument matters less than the function, a portion of the portfolio that does not correlate directly with stock market movements. This is the allocation, and this is where most people, upon hearing it, make the decision that separates the portfolios that reach $1 million from the ones that do not. You are somewhere right now, maybe at a desk, maybe on a couch, and some part of you is waiting for the part where this gets more complicated. It does not. Here is the insight almost nobody discusses, because it does not involve anything to buy. The investor who reaches $1 million portfolio is almost never the one who found the best allocation. It is the one who found an allocation they could hold without modification through 2 or 3 major market corrections. The 2000 dot-com crash, the 2008 financial crisis, the 2020 pandemic drop. In each case, the market recovered and reached new highs within a few years. In each case, the investors who held their positions through the decline participated fully in the recovery. In each case, the investors who exited, even temporarily, even strategically, missed enough of the recovery that their 10-year returns were materially worse than the investors who did nothing. This is the behavioral data. It is not theoretical. The question is not which allocation is mathematically optimal. The question is which allocation is psychologically holdable for the specific investor under real market conditions with real money at stake, when every financial news outlet is running headlines that suggest the current decline is different from all the previous ones. The answer to that question determines the outcome more than any allocation decision ever will. If you know someone who is still watching financial media for portfolio guidance, someone who has been repositioning every time a recession looks likely, this is exactly what they need to see. Not because the information is rare, because hearing it framed this way, in terms of the behavioral architecture rather than the asset picks, is what actually lands. This channel does not tell you what the market is going to do. Nobody can. What it does is go deeper than surface-level allocation advice into the actual mechanics of wealth building, the sequence decisions, the fee structures, the behavioral patterns, that the financial services industry has every incentive to keep complicated. If that is the level of depth you are here for, you are in the right place. The one thing to do tonight, not next quarter, not after the next paycheck, tonight. Open the account statement for any actively managed mutual fund currently held in any portfolio. Find the expense ratio, multiply it by the current account balance. That number, that specific dollar figure, is what active management costs annually in hard fees, before accounting for the underperformance drag that compounds on top of it over the following decades. Most people have never done this calculation. Most people, when they do it for the first time, experience something between mild irritation and genuine anger. That feeling is the beginning of a different relationship with money. The framework above, the sequence, the allocation, the behavioral architecture, is not complicated to understand. The genuine question, the one this video cannot fully answer, is why the gap between understanding it and executing it is so wide, so consistent, and so resistant to information. If that question is the one you are still turning over, the answer is not more financial content. It is worth sitting with why. What did you already know going into this video, and what shifted? Drop it in the comments. Not because it helps the algorithm, because the specific thing that shifted for someone who already knew the basics is different from the thing that shifted for someone hearing this for the first time, and that gap is worth naming.